We are recording now. Hey, everyone, welcome to the Hurley Investments midweek commentary on the 10th of February 2016. I've got some individuals here with me today, and I was just telling them that as I was preparing my information for today, I decided I was going to do things a little bit differently. I wanted to go over today I got a little series of 3 classes I teach on why it's more important to not lose. And I felt I would best serve you guys to go over that with you today than to try to show an explanation of the stock market, to go over why things are happening, economic reports. In all honesty, I feel like I don't have an answer for the stock market. In fact, as I looked at the stock market, I literally, as I was putting all my stuff together, made the comment to myself and said, fundamentals don't matter, technicals don't matter, economic events don't matter, nothing matters. So if nothing matters, I don't have an answer to give you guys on what's going on in the stock market or why. I don't feel comfortable really even telling you guys or suggesting to you that something's happening and that we should be paying attention to it, because literally nothing matters. And when nothing matters, everything we're trying to point out or suggest, unfortunately, is just, I don't even call it a best educated guess. It doesn't matter. And because it doesn't matter, I've chosen to give you guys a little class on why it's more important to not lose. And I just want to talk the last half hour. Are you guys okay with that? Does that make sense to you? Give me a couple comments. Sure. All right, perfect. This is actually a marketing class that I use for Hurley Investments. No, I'm not really in education. That's why I've got myself with Jeffrey. Jeffrey taught me who I am, what I do. I'm going to give all the credit over to them. But this is a little bit about understanding why it's important to not lose. The problem that everyone faces in the stock market is not understanding what the differences are between average rate of return that's reported on your investment statements and portfolio growth. That is what is killing most people, that they don't understand the problem that an average rate of return and what's reported on your investment statements is not portfolio growth. I will speak with you later on that, Abraham. Really quickly, what is a 10% gain in year 1 and a 10% loss in year 2? Give me a percentage. Where are we at? 10% gain, 10% loss. Where are we at if that occurs? %? It's an average of a 0% return. Abraham, Dan, love your answers there. Yes, it's an average of a 0% return. But in real life, it's a portfolio growth of being down 1%. Key to understand, average rates of the return are not your friend. They never are. What are they? They're just that. They're average rates of return over 1 year, 3 years, 5 years, 10 years. They are just averages. They are not portfolio growth. I had a client give me a call, and he said, Kevin, I opened up a magazine, saw an advertisement for a fund that I own. the bold print bragged that the fund had averaged 5% over the past 3 years. I went home, looked at my statements to confirm what I had suspected. Kevin, I had lost money. How could this be? And it's interesting because I went through what an average rate of return is. And I helped him understand the value of $1. I'm going to do that for you guys a couple different ways here. Let's take the value of $1 and let's use it with a 50% gain in year 1 and a 50% loss in year 2. I'm going to give you the ability to make more the first year. Will someone please tell me, what is a 50% gain, a 50% loss on $1? Both of you are correct. We're down 25%. It is worth 75 cents. Someone tell me, what is the average rate of return? What is the average rate of return? Bingo, 0. So your average rate of return is a 0%. No gain or no loss. But your portfolio growth is a 25% loss. You've given up 25% of what you worked so hard for. I love it because I hear people say, well, Kevin, that's not happening to us. It doesn't happen in our market. The reality is it happens so often and on such a slow, monotonous. You don't look at your 401k statements. You don't look at your pension fund statements. January 98 through 2002. 3 positive years, 2 negative years. What does that look like in real life? Well, you saw a gain of your dollar of a 58% return. You then saw that 58% return lose 49% over the next 2 years. One more time, I know I'm beating it in your head. Average rate of return was up 4.5%. Your funds made a 4.5% return. Your growth in your portfolio? You lost 23%. Over that 5-year period on your fund, not counting fees, the value of your fund lost 23%. I want to show it to you one more way. And of course you're saying, Kevin, I get it. I get it, I get it, I get it. Take a quick look at that chart. Take a quick peek at it. Those are S&P 500s from about the beginning of 2000. We always talk about Japan, China. Japan's had a lost decade. Well, I hope you understand the United States has had a lost decade. They've had a lost decade and then some. Anywhere from a 12.5 to a 13.5 year period, we had 0 growth on the S&P 500. Decades, we're talking 10 years or more. Now, let's return to averages. Let me explain to you one more time why it's so important to understand averages. a 4.5% upside over a 5-year period in our stock market, an average of 4.5% growth, gave you a 23% loss. To understand why this is so important, there will come a day when you're done working where what you have is what you have and nothing more. At that point, it is vitally important to not lose. In fact, if I can go so far as to say, our stock market, our way of investing, is literally killing the golden goose. If you had $1 million in 2000 and you wanted to withdraw 6% a year, kind of live the lifestyle you've lived, go ahead and you add on to make 75, 80,000, you add on Social Security, withdrawing that 60,000 a year, you would have run out of money at 11.8 years. In fact, if you had started anywhere in that 10-year period from 97 all the way up into 2012, you would be running out of money at a faster rate than life expectancy. I have people tell me this all the time, and Abraham, you've just hit on it. How? Why? I don't get it. It comes down to one simple thing. How you measure risk is not the same way the financial industry does. Let me give you a quick example. I want you guys to tell me, what do you consider a low risk portfolio to be? What do you guys consider a low risk portfolio to be? Give me a percentage. What's the risk? What's the risk as a percentage basis on a low risk portfolio? All right, and survey says 10%, 3%. Okay, so what is a medium risk portfolio then? What do you think a medium risk portfolio is then? Abraham says negative 10%. Dan, what do you think a medium risk portfolio is? Oh, Dan's at 25. And how about a high risk? What's a high risk? What's the most a high risk portfolio can lose? $40 to $50 for Dan. Abraham, what do you think? What is a high risk portfolio? What do you think the most that one could lose? Lance. Not everything. That's a little extreme. %. Okay. In that case, using your guys' numbers, why did no one go to jail? When obviously everyone lost more than those averages. It's funny, low risk is considered losing 25% of your portfolio. High risk is considered losing 75%. Medium risk is considered losing 50%. If you'll notice, in 2008, a big outflow of funds when the stock market was down roughly 21%. And it went from out of equities into treasuries. So that those low risk funds were nowhere close to 25% down. They were only down 18, 19. When the stock market was down 35%, another big outflow. In fact, the stock market in 2008 was down as much as 46% in one time. Big rush out so that people were protected. Plain and simple, the industry, my industry, does not measure risk the same way you do. In fact, to keep it simple, you wonder how your moderate portfolio lost 30% in the last Do you wonder how your moderate portfolio lost 35% in the last crash? It's imperative that you not understand your risk tolerance, but you understand the risk tolerance of the person managing your money. Pretty simple. This is pretty standard. I have the Smiths here, right? 60 years old, retiring in 2 years. Their home's paid off, and they have $1.5 million in retirement assets. They want to draw $130,000 a year during retirement. Their advisor, any financial planner, we all use the same software. It's going to give them a portfolio with a recommended portfolio of 65% in stocks and 9 different asset classes and 35% in 3 different classes of bonds. When you calculate all this gooey information, so to speak, you find out something called a standard deviation. What advisors don't tell people in plain English. We're going to create that portfolio with those ratios that's going to give you an average rate of return of a 10.18%. First thing to recognize, and I hope you guys understand this, at a 10% on 1.5 million, what is that dollar figure? What is 10% on 1.5 million? There you go, it's $150,000. Notice how they only needed 130? Where do you think that 20,000 goes? Where do you think that 15% disappears to? Yes, it's going to disappear in management fees of some way, shape, or form, won't it? So, hey, we're going to generate you a higher than expected rate of return. Not so you can get your 130,000, but so I can collect my fees and you won't notice. Hey, we give you a standard deviation risk of 14.89. And we think against 100, that is a low amount of risk. But in a market crash, and a market crash is only a bear market, a 20% drop. And a bear market crash, quote unquote, this portfolio could very easily lose 45%. Kevin, you're full of crap. You don't get it. Nope, only licensed bond insured. Let's go over bonds. A big portion of those bond funds are going to be in high risk corporate bonds and in muni bonds. Will someone please tell me, how did those do through 2008? How did high-risk corporate muni bonds do through 2008? You literally could have lost roughly 17% of your portfolio in those bonds that went bankrupt, munis included. Hey, 65% different asset classes all across the board. How well did those do? Well, they lost 38% in 2008. And don't forget, 90 some odd percent of funds can't meet or beat the S&P 500 average. Can you now see how dramatic it is to possibly lose 45% of your retirement assets? Steve, nice to have you join us. I am recording this, so you will get to see the first part that you missed. Guys, something else to understand, simple numbers. Market crashes happen. That is a correction of 20% happen every, market crashes of 50% more happen every 4.2 years. Well, why is this important? Life expectancy for a 40-year-old is 91. A 30-year-old is 94. This is important for you just to calculate how many more market crashes will you experience in your lifetime. 6, 8, 12, 12 or more. You guys literally need a methodology that's going to cover market crashes, dips, and spikes. And that methodology is obviously someone that can manage money into those regards, or the Safe Option Strategies education. I'm going to pull out of this one. I want to go to one other one really quickly. And I like using this one, and then I'm going to just free it open for questions from you guys. Key, what's making money in the new normal? Since 2008, when everything before that no longer matters, what's making money in the new normal? And the key is, how can you do it yourself? Obviously, the buy and hold strategy, truly, if you take a quick peek at fees, it hasn't worked. Buy and hold hasn't worked since the Vietnam War. Plain and simple. The reason why it hasn't worked since that Vietnam War comes down to the simple fact that it takes basically twice as much to get back to break even. But I use stop losses. I always see this one all the time. Kevin, I'm a stop loss guy. I'm shocked that people don't understand what a stop loss is. That a stop loss is nothing more than an electronic trigger to place a market order to sell a position. So, Kevin, that protects me. What about when a stock gaps? When you got that stop loss set and futures are down 2% in the morning, that stop loss books you for that loss. It can gap right through the price that you had that stop loss set at. A stop loss is usually nothing more than booking a loss. Funds, mutual funds, REITs, ETFs, MLPs, aren't those working? Don't those make us all kinds of money? They could. Dan, you are correct there too. They could, except for the fact that fees, restructuring, rebalancing, churning commissions, 1201B fees, hidden fees, taxes, all those equal subpar or lower returns. I love this one though. But Kevin, futures, Forex, currency swaps, come on, day trading, that's the way to go. I've talked to probably over 25,000 professional and personal, I guess non-professional traders in the stock market. so simple, so easy to explain. With big rewards comes huge risk. I still have not talked to a day trader that's been profitable 2 years in a row. It's ugly. It's tough. It's very hard. I would go so far as to tell you it's impossible, but I'm sure there's probably someone out there that that can show that they're making money. I just haven't met him yet. I don't get it. I don't see it. Doesn't mean it can't happen. Just means that it's not happening right now. At least not to an explanation that that I understand. With that said, let's talk options. We can do spreads. We can do condors. We can do single options. I'm just going to make it plain and simple. 80% of the time, people lose because of the odds of profitability. When you throw theta decay, time decay, directional spreads in there, obviously, no, I'm not exactly counting you guys, but the short answer is I don't see people using options and leveraging of options to be profitable. I just don't see it. Probability of the rates of returns with options. I love using this example, and I use it literally all the time. If you have a long call, you make money when that goes up. As it goes sideways or down, you lose money. I would tend to say that gives you a 1 out of 3 chance of being profitable, which equals 33%. If we have a 33% chance of being profitable, what's the chance of not being profitable? There you go. Dan, you're right on it today. Lance, you too. Abraham, I know you've been on it too. 67% chance you will lose money in the stock market. And I'm not making this up. This is just plain and simple addition and subtraction. It's not funky numbers. I'm not hiding anything here. It literally just is what it is. I don't get how some people think that these numbers don't add up. The numbers are exactly what they are. Nothing changes. It is what it is. It should be pretty simple to understand. Well, Kevin, I do credit spreads. Again, risk to reward ratios. Doesn't make any sense. You're not turning it. The only thing that's turning it is literally an adjustment process. All right, let's go through. I went through that already, going through a little bit early here. Don't forget theta decay, time decay. Usually even on credit spreads, risk to reward, you don't get there. I went through the client experience with you guys. What does seem to work, and this is my risk to reward ratio on credit spreads. Obviously, no, I'm not a big fan of credit spreads, and it is because you could win literally 24 times and lose once and lose everything you paid for. It just, the risk to reward doesn't make a whole lot of sense. I've tried to show people the advantages of seeing, well, Kevin, I trade in a good blue chip stock like Apple. Nah, Kevin, Apple's too volatile. So like Disney. Nah, I trade in something even better than that. I trade in something like General Electric. I'm sorry. With all due respect, I still see risk. I still see gaps. I see gaps and movements to the downside. I see small gaps that get you out. I see big one-day gaps that get you out. I don't see a safe position in the new normal that doesn't require some protection. I went through our lost decade to help you guys understand where we are with our lost decade. I'm going to put this a little bit differently for you. Big red flag. I see people that brag about average rates of successful trades. They got a winning percentage. One more time, a winning percentage is nothing more than a winning percentage. It does not mean that you are going to be profitable and be making money. It just doesn't. It doesn't come out that way. What it does come out as, you can have a 97.7% chance or success of winning trades. You can have a 58% gain with winning trades. Those two big losses, or a 49% loss in the portfolio, and your $10,000 portfolio is down to $7,700. We've gone through our lost years of training. I've already gone through when you have what you have is what you have. How many more market crashes and dips? I've gone through the risk. Collar trade. I go through a collar trade example for certain people. Really, the short and the skinny of it is the collar trade is what I have seen that makes a difference. I go through a collar trade here on Apple, and the short answer is when Apple had its big day where it spiked down to $92 a share, it literally was a profitable day for Apple and a way to pick up another 100 shares. Even though Apple finished down at 98, if you had collar traded and actively managed it, you literally, on a stock that was down roughly in a day, down $12 or 10%, you could have added 10% more shares and been up a couple percent. That's what collar trading is. I don't have to talk it into you guys because you get it. The whole idea of adding shares, picking up more shares, insuring your stock when it drops 18% doesn't mean you have to make money dollar for dollar on the way down. Anything you make on the way down is profit on the way back up. Simple example, if you could lower your cost basis down to 95, does it beat being down from $110 a share? Are you profitable at 95? Not yet, but you're only down 66 cents. Will you be profitable at 110 again when most people are getting out at a break even? Heck yeah, you picked up extra shares of stock. You were doing really, really good by getting to pick up those extra shares of stocks with your profit. I do go through and I do show how important it is on a Netflix covered call, a Netflix collar trade. I always have someone that says, Kevin, but does it really work in real life? Pretty cool. When your shares are down 64% and you're making up 75% on a volatile market on the way down. And it's percentage, it's cents. Shares down 65. Your December puts are up 25. There does come a point when you make up more on the way down than your stock loses. Fabulous position to be in. Fabulous way to trade in the market. Does it work in real life? Of course it does. Guys, let me turn the time over to you. What questions would you like to ask me today? I didn't have I didn't feel comfortable going through my normal, I didn't feel comfortable going through my normal explanation, my normal midweek commentary and spouting out some information, because none of that information seems to matter right now. Abraham made the comment, Kevin, I thought about shorting, buying longs on the E-minis or just going out and buying puts on the SPY. I think it's a good idea. Plain and simple, taking a quick look. I think it's a really good idea. I take a look at the XPX, maybe the SPY. We still have lower lows. We're really, really testing that 1850 mark. 1850 and 1900. We got a battle going on right now. And we break through 1850, it would, excuse me, it would not surprise me to see us go all the way down to 1750, if not 1700. There's just no buying opportunities. There's just not a bid to the downside right now. Pretty rough. Pretty rough. Someone just made the comment. They're fine with me not going through my everyday stuff. It's kind of a refresher. Someone suggested I might write a book on this. I'd want to, but the neat thing is I get to talk to you guys. Abraham, Dan, Ida, Steve, Mary, Lance, David, Doug, Alan. I get to talk to you guys. You guys get it. You guys are either my clients or you're taking the education that puts you in a different position so you don't have to worry about a lot of what I said. But I'll be honest with you, guys, I wouldn't have any money with, I just wouldn't have any money with a big box right now. I don't see, I don't see how people don't get that the stock market on $7.5 million should have been down $59,000 today. And, we all have our good days, our bad days. I get that. But I'm going to kind of take a look at everything as a whole here. And let me just give an example of today. I'm down today on $7.4 million. I was down 2,718. Not bad on a 0.62% drop. It more matches the S&P, which is flat. But I'm okay with those kind of days, especially when, unfortunately, some of my people are getting crushed by Disney. Rolled puts out in time, captured profits, added more shares. Great earnings on Disney, and the stupid thing's down $3.50 today. I really like being down $20,000 or $25,000 when the stock market's down 2%. I'm okay with being down 1/3% when the stock market's down 2%. Does that mean I won't make quite as much on the way up? Of course it does, if I've got my protection in place, but then I get to add shares. Guys, I don't understand why people have money with the traditional stock pickers, with the traditional big boxes. Any type of fund is charging between 5.5% to 7%. No questions asked. Done. It's just the way that is. So let me answer questions from you guys. Lance, so would you suggest I would be out into cash? Lance, here's what I'm going to suggest to you. Lance, we buy insurance on our home, our house, our life, our wife, our autos. Most people insure themselves so they can get to retirement. But what happens is when they have forgotten in some way, shape, or form to insure that revenue stream. We don't insure our revenue stream. And I'm sorry, I can show you all kinds of lost decades and times when the stock market hasn't made money over a 5-10 year period of time, when if you're paying those exorbitant fees, you don't get to retire. So what I am going to tell you is this. Plain and simply, I don't know why people would have money in funds and stock pickers of any kind that aren't using the options and the right to sell your stock at a certain price. You're insuring everything you can to get to retirement except for that revenue that you're going to need once you retire. Dan, when is a good time to get into new trades? So when do you find a stock that you like? When a stock starts to go up just for earnings? All right, Dan, I'm going to give you two different thought patterns on here. And I'm going to have you answer your own question. Dan, how are you at outguessing the stock market? Good, bad, or ugly? Terrible. Love it. So, on spread trades, you're using technical analysis and levels of support and resistance to decide your entry and exit points. They also help you justify or understand a percent return. If you've got a level of resistance only $2 up, you're not expecting a $2 return on a spread trade. You're looking at 50 cents. Now, Dan, with the understood idea that you, myself, we are terrible at outguessing the stock market, when you're initiating a position, the two schools of thought are, if you've got it insured in a collar trade, the timing doesn't matter. Up, down, or sideways, you've got positions in play to make money so that you can trade in a process and take advantage of market movements. The other line of thought process is, if you're going to collar trade and you want the best bang for the buck, you run out to an earnings event. You set up your trade a couple weeks before earnings so you're not overpaying for protection, and you run through that earnings event to get the big pop up or down on the movement of the stock, using those options to hedge your risk to the downside. Right now is not a good time to be putting money to work. Going right back to our chart, I'm going to use the SPX. We're in no man's land. Let me shorten this out a little bit. Let me go out to 6 months. Let me go out to 0 years. Dan, if I was looking at a chart right now, I can justify we might be at a bottom, but here's your simple answer. Clear as day. No man's land on the RSI. No crossovers. On uncertainty laying on top of it, looking like it might be crossing over to the downside. Right now is not a time to be looking at entering positions. Unless you want to do Baidu, which has its earnings coming up sometime in the near future. So, Dan, I should ask you, does that answer your question? Perfect. Steve, out of curiosity, are you the Steve that's out in the, I want to say Seattle, but the Washington State area? Alrighty. Thanks, Steve. Guys, what other questions do you have? What else would you like to go over? Obviously, I'm a big proponent of the collar trade. And guys, you can do so much better than a fund, or get it out of the fund and have someone else do it for you that does use this style of trading. CCL, probably Carnival, right? Carnival Corp. Pretty neat that today it was up, but it's getting nothing more than what looks to be a dead cat bounce. Bouncing off of an oversold. Definitely do not have crossovers on the 5 and the 20, nor the MACD. Plenty of upside before it hits resistance on institutional money. I think it has earnings coming up, but it obviously is in a downtrend. No near-term support. Actually, near-term support's been broken at that 47 range. Abraham, how do you see interest for the next times? Interest. I think if we're talking about interest rates and Yellen, I don't think we're raising again year to date. They paint themselves in the corner. They missed raising interest rates in September. Instead of just saying they missed it and helping the economy chug along, they had to prove that they needed interest rate, and it dinged our economy. So I don't think we're going to have any more interest rate hikes for today, for the year. If they do, they are not helping. They are not helping growth in the economy when you have to now pay more to borrow money and to create jobs, to create infrastructure, to pay for raw materials and so forth. Dan, how about using bull put spread to get into a new trade, and if you get assigned, then collar it? Dan, I'm going to come back at you and I'm going to ask you a question. If you're doing a bull put, you're expecting bullish movement on the stock. So I'm going to ask you, why would you trade for nickels and dimes when you could make dollars on your stock? Why are you trading for nickels and dimes when you could be making dollars on your stock? Well, Kevin, if it gets assigned, I'm going to collar it at that point. Kevin, I want to give myself a little downside protection. Please don't think of credit's downside protection. If you are doing a bullish trade, a bull put on a bullish stock, why would you trade just for the credit, not for the dollars the stock can get in, that you could get into? Why would you not own the stock to be more beneficial on a stock split, on a dividend play? Why, if your plan is an adjustment, is to have the money set aside to collar it, why not just collar it from the start? Deanne, that's an interesting question, because I have a lot of people that ask me that. And I in no way, shape, or form am I trying to be rude. And this really does come down to more of a personal preference. But the neat thing is, and you just made the comment, because many times there's a sideways activity. Trading is a process. Get into it at earnings where historically you're not going to get a sideways activity. And again, I guess I kind of trade looking at the stock from quarter to quarter, and I don't see a whole lot of sideways activity that I still couldn't capture something along the lines of a collar trade. But again, the neat thing is, remember, Dan, this is a personal preference. I bet, Dan, you probably would run circles around me on credit spreads. I'm not a good credit spread kind of guy. In fact, my credit spreads, I'm most successful looking to take out 25 to 50% of the credit. That's where I'm most successful. You might come back and tell me clear as day, well, Kevin, I really see it with my eyes. I really see those short-term movements. I'm really more of an in and out kind of guy, in which case your bull put spreads are going to be perfect. The main answer is make money. Make money. And the way you phrased your question, you have a chance to make dollars. So I wouldn't be trading my chance to make dollars on the hope to make some cents on a credit. Thank you for your question. And Dan, perfect. I appreciate your comment. Thank you. Any other questions? What is your take in calm? All right. Calm. Cal-Maine Foods I see all the time. I would consider it to be a defensive play, right? I'd look at it and say, hey, it's a defensive player. It's traded sideways. It's up slightly for the year, but really, Cal-Maine Foods is a defensive play against the volatile market. It's still plenty volatile to do a collar trade. Nobody stops eating. That's why it's defensive. It's not, I mean, it obviously has some growth to it. Looks to be a good collar trader, but you have to be nimble. OZRK. Doesn't ring a bell out of the gates. Bank of the Ozarks. Don't know them at all. But if I was going to play big financials, I would feel more comfortable playing a big financial that's already been saved than a Bank of the Ozarks. I might even want to see some big financials in something like a Zions Bank, a regional that has some upward movement. But if I was in financials, I like Zions. I'd want to be in the bigger names like Bank of America, JP Morgan, Goldman Sachs. The XLF might not be a bad way to trade the banks, knowing that if they do raise interest rates, financials should have a kick to the upside. NetEase. The only Chinese stock that I would want to be playing right now are Alibaba and Baidu. Man, I used to trade NetEase, believe it or not, between $17.50 and 22.5 cents on the dollar. I am not comfortable that when, and NetEase may have changed since I've last traded them, obviously. I would not be as comfortable in NetEase, the Chinese gaming platform, because I think when times get tough, people are more likely to buy things cheaper online through Alibaba and or do more searches online. I think the whole advertising is moving to online, in which case I'd want to be in Baidu. Yeah, I got to play Baidu from 165 up to a 775, 10 for 1 split. Baidu is the one that I've made my most money on ever, but my choice is not to be in gaming. As world markets get tough and harder, I don't see gaming in China as when people get worried about money, that's where they're going to spend their money. But NetEase has big, nice movement. And yes, I wish I hadn't ever have gotten called out at 22.50. So Abraham, hopefully that's a little bit of good information for you in regards to your stocks. Anything else for you guys? Again, I'm sorry I did not use my typical I don't know how to say it, worksheet. I just kind of felt like it didn't matter today. Dan, Apple seems to be stuck in the 95 range. Dan, I think Apple is now stuck literally for the law of large numbers. What I mean by the law of large numbers, most stocks to go up have to have three things: beat on top and bottom line for earnings and have future guidance that's above or beyond analyst expectations. Apple does not. Apple has to beat on top, bottom line, and on guidance. It has to beat on number of iPhones sold, number of iPads sold, number of Mac computers sold, number of iWatches sold. Has to beat on services revenue, subscriber revenues for their music. Has to beat on apps. Has to beat on the iPay platform. They're like 12 different numbers, revenue numbers, gross margin numbers, operating income margin numbers. It literally has like 14 numbers that Apple has to beat, while most other stocks only have to beat 3 numbers. I think Apple is literally stuck in the law of large numbers. When we get the next release of the iPhone 7 and it takes off $20, $25, I'm going to be using it as a selling opportunity to be exiting Apple and shifting money over to most likely Facebook. Great question, Dan. Alrighty, guys, if you ever do have any questions, or if there's ways that I can be helpful for you, do me a favor, copy down that toll-free number. You can always send an email off to me. Again, this is kind of unusual for me to use this. Usually I want to go through my standard Word document, go through a bunch of information with you. Again, I just kind of felt that in today's ridiculous market, that information would not necessarily be helpful to you. So I took a look at things a little bit differently. I appreciate your time today. Thank you for being with me. I look forward to talking to you all next week. Have a good evening, and I'll talk to you then. Bye-bye.